Hi everyone, welcome to Formulating Finance. In this video, we will be discussing about gold exchange traded fund concept and how to invest in it. First of all, if you are new to the channel, do subscribe and press the bell icon so you get the instant notification about the new videos. Want to own gold? Want to collect it for marriage purposes? Want to surprise your spouse? But scared of high valuations? Average price in FY19 of gold was 35,000 for 10 grams, 39,000 in the beginning of 2020, and 50,000 in mid 2020. 28% returns in half year. But still want to be a part of enormous returns. Apart from these, there are various issues why a person won't like to invest in physical gold but still want to enjoy the returns. So, we have a solution for it. Invest in gold ETF. So, what is gold ETF? Let's find out. Gold ETF is a commodity based mutual fund. That is, the underlying asset is gold and tracks domestic physical gold price. They are passive investment instruments that are based on gold prices and invest in gold bullions. In short, as an investor, you hold the units of a fund and the fund holds the physical gold with them. One gold ETF unit is equal to 1 gram of gold and is backed by physical gold of very high purity. Gold ETFs are listed and traded on National Stock Exchange (NSE) and Bombay Stock Exchange (BSE) like a stock of any other company. Gold ETFs trade on the cash segment of BSE and NSE like any other company stock and can be bought and sold continuously at market prices. It is an efficient way to buy gold rather than blocking huge amount of money in a physical asset. When you actually redeem gold ETF, you don't get physical gold but receive the cash equivalent. Because of its direct gold pricing, there's a complete transparency on the holdings of a gold ETF and it moves in relation to gold prices. Further, due to its unique structure and creation mechanism, the ETFs have much lower expenses as compared to physical gold investment, that is, brokerage up to 0.5%. It is a big protection in a portfolio when equity market fails to give good returns. Gold comes as a life savior. It is the best alternative for someone who wants to track gold prices or wants to invest in gold but wants to save himself against theft, storage costs, handling costs, etc. Advantages of gold ETF. Purity of the gold is guaranteed and each unit is backed by physical gold of high purity. Transparent and real-time gold prices. Listed and traded on stock exchange. No fear of theft. Safe and secure as units are held in a demat account. One also saves on safe deposit locker charges. A tax efficient way to hold gold as income earned from them is treated as a long term capital gain. No wealth tax, no security transaction tax, no VAT, and no sales tax. ETFs are accepted as collateral for loans. No entry and exit load. Diversification. Investing in gold ETF helps an investor to diversify and spread his investments in safer investment classes. Let's compare the jewelry that we buy and the gold ETF. At the time of purchase, they are making charges of 10 to 20%, and in gold ETF, there's just a brokerage of 0.5% or even less. During sale, 10 to 20% is lost due to purity loss issues in jewelry. In brokerage, for selling, it's just 0.5%. For maintenance, insurance charges and locker charges are there in jewelry, but for gold ETF, there's just 1% for fees of the fund. How is NAV calculated? Gold ETFs are valued every day based on the prices published by the London Bullion Market Association twice a day. The daily LBMA prices are taken by the fund houses, converted into rupee terms after adjusting for custom duty and other costs such as GST, and NAV is calculated. The NAV price is also known as the landed price of gold. Can a price of unit deviate from NAV per unit? The answer is yes. NAV is derived using value of gold assets. In recent times, as the demand for gold investments have gone up, so some of the gold ETFs are trading at a premium to physical gold prices. Tax implications. Just like physical gold, gold ETFs are taxed in two categories. First, short term capital gain. If the difference between the date of buying and selling of a unit is less than 36 months, it attracts short term capital gain, which will be taxed along with the current tax slab rates. Second, long term capital gain. If your holding period is greater than 36 months, you will get an indexation benefit along with gains tax at 20% and a cess of 4% on tax rate, that is 20.8%. Some of the gold ETFs traded on stock exchanges in India: Axis Gold ETF, Birla Sun Life Gold ETF, HDFC Gold ETF, ICICI Prudential Gold ETF, KOTAK Gold ETF, SBI Gold ETF. Let's compare gold ETF with physical gold. Since inception, Kotak Gold ETF gave return of 13.2% and price of physical gold has increased by 14.48%. The difference in return in ETF and physical gold is very less and is due to the management fees that is charged by the fund. Details of Kotak Gold ETF. Minimum trade units on exchange is 10 units. NAV as on 29 July is Rs 466. Exit load of 1% if redeemed within 1 year. Ideal holding period would be 3 years. All these parameters would change according to a fund. Let's see how you can buy Kotak Gold ETF on exchange. Go to Kotak Gold, click on B for buying units. In quantity, you have to add in multiples of 10 and enter. And these units will be credited to your DMAT account. Thank you everyone for watching the video. Please like and share the video and subscribe to my channel, Formulating Finance. Thank you all.